Bitcoin, the digital currency created a dozen years ago as an alternative to cash, is exploding in value. Will it last? Many financial experts dismissed the cryptocurrency as a fad.
This is the largest decentralized application when no one controls any of it.
Decentralized everything.
Bitcoin itself is a decentralized.
Well, now the Doge father. Okay, Doge father. So
Elon Musk tweets, "The world listens."
Bitcoin dropping more than 3% today after another cryptic crypto tweet from Elon Musk.
Cryptocurrencies have emerged as an asset class that provides you with a chance to invest and earn substantial returns. Despite the lack of government backing in most regions of the world, this asset class has garnered massive popularity in recent years. The probability of handsome returns over a short period has propelled investors to jump onto the crypto bandwagon. Cryptocurrency is absolutely on fire these days, and many investors are looking to profit on its white-hot rise. Well-known cryptos such as Bitcoin have surged again, and other popular digital currencies are rallying too. Experienced traders have been speculating on crypto for years. But what if you're new to the market and looking to get a piece of the action? Is there anything you'd like to know? Feel free to ask in the comments section below. That said, here's how to start investing in cryptocurrency and what you need to watch out for. First things first, if you're looking to invest in crypto, you need to have all your finances in order. That means having an emergency fund in place, a manageable level of debt, and ideally a diversified portfolio of investments. Your crypto investments can become one more part of your portfolio, one that helps raise your total returns, hopefully. But first, these are the steps to follow if you're a beginner. Step 1. Select the right crypto exchange. Due to the absence of crypto regulation in most countries, there's no fixed structure or uniformity to trading in cryptocurrency. But with the help of the Crypto Exchanges platform, you can easily buy and sell your digital currency. Make sure you settle for the best one. Step 2. Open a trading account. You have to open a trading account at the crypto exchange of your choice. This account will be similar to that in a bank. While registering, the exchange will verify your credentials based on the services you opt for, the amount you plan to invest, and the available coin trading options. It will require sharing KYC, initials for Know Your Customer data, and setting up payment options. For KYC, you may need to submit copies of your bank card, photo identity, and address proof. Notably, crypto exchanges function round the clock throughout the year, unlike regular stock exchanges. Step 3. Fund your account. After opening an account, you have to transfer some money into the crypto trading account to buy cryptocurrencies. You may transfer the funds online from your bank account to the crypto trading account. It, however, requires linking both accounts. Moreover, depending on the policy, you may have a waiting period before purchasing digital coins. Step 4. Buying and investing in cryptocurrency. Following an account and money transfer, you need to decide on the coins you intend to invest in. By far, some of the popular ones are Bitcoin, followed by other altcoins such as Ethereum, Cardano, Binance Coin, Tether, XRP, and Dogecoin, to list a few. Step 5. Store your currency. Storage is the most important part after you make your purchases. Crypto exchanges do not have any formal institution backing them, and they most assuredly do not carry your average insurance policy. They also face the uncertainty of being hacked. Therefore, you must store the codes to your account and your assets securely. It's usually advisable to store your purchased coins in a crypto wallet. Number 6. Choose a strategy. Make an excellent strategy to earn more profits by adopting Elliott Wave Theory. Elliott Wave Theory concentrates on the psychology behind the market sentiment, so it acts well for speculative assets like cryptocurrencies. Moreover, you can get some crypto experts' opinions that can be beneficial before expanding one's investment in cryptocurrency. One should always start with small investments and study the market carefully instead of blindly following anybody's advice. After taking care of those basic steps, there are other essential aspects to take care of. Here are some of them. 1. Understand what you're investing in. As you would for any investment, understand exactly what you're investing in. If you're buying stocks, it's important to read the prospectus and analyze the companies thoroughly. Plan to do the same with any cryptocurrency since there are literally thousands of them. They all function differently, and new ones are being created every day. You need to understand the investment case for each trade. In the case of many cryptocurrencies, they're backed by nothing at all, neither hard assets nor cash flow. For example, that's the case for Bitcoin, where investors rely exclusively on someone paying more for the asset than they paid for it. In other words, unlike stock, where a company can grow its profits and drive returns for you that way, many crypto assets must rely on the market becoming more optimistic and bullish for you to profit. Some of the more popular coins include Ethereum, Dogecoin, Cardano, and XRP. Newcomer Internet Computer recently burst onto the scene too. So before investing, understand the potential upside and downside. If your financial investment is not backed by an asset or cash flow, it could end up being worth nothing. Number 2. Remember, the past is the past. Many new investors make a mistake by looking at the past and extrapolating that to the future. Yes, Bitcoin used to be worth pennies, but now it's worth much more. The key question, however, is will that growth continue into the future, even if it's not at quite that meteoric rate? Investors look to the future, not to what an asset has done in the past. What will drive future returns? Traders buying a cryptocurrency today need tomorrow's gains, not yesterday's. 3. Watch the volatility. The prices of cryptocurrencies are about as volatile as an asset can get. They could drop quickly in seconds on nothing more than a rumor that ends up proving baseless. That can be great for sophisticated investors who can execute trades rapidly or have a solid grasp of the market's fundamentals, how the market is trending, and where it could go. For new investors without these skills, or the high-powered algorithms that direct these trades, it's a minefield. Volatility is a game for high-powered Wall Street traders, each of whom is trying to outgun other deep-pocketed investors. A new investor can easily get crushed by the volatility. That's because volatility shakes out traders, especially beginners who get scared. Meanwhile, other traders may step in and buy on the cheap. In short, volatility can help sophisticated traders buy low and sell high, while inexperienced investors buy high and sell low. 4. Manage your risk. If you're trading any asset on a short-term basis, you need to manage your risk, which can be especially true with volatile assets such as cryptocurrency. So as a newer trader, you'll need to understand how best to manage risk and develop a process that helps mitigate losses. And that process can vary from individual to individual. Risk management for a long-term investor might simply be never selling, regardless of the price. The long-term mentality allows the investor to stick with the position. However, risk management for a short-term trader might be setting strict rules on when to sell, such as when an investment has fallen 10%. The trader then keenly follows the rules so that a relatively small decline doesn't become a crushing loss later. Newer traders should consider setting aside a certain amount of trading money and then using only a portion of it, at least at first. If a position moves against them, they'll still have money in the reserve to trade with later. The ultimate point is that you can't trade if you don't have any money. So keeping some money in reserve means you'll always have a bankroll to fund your trading. It's essential to manage risk, but that will come at an emotional cost. Selling at a losing position hurts, but you'll need to do it occasionally to avoid much worse losses later. 5. Don't invest more than you can afford to lose. Finally, it's important to avoid putting money that you need into speculative assets. If you can't afford to lose it, all of it, you can't afford to put it into risky assets such as cryptocurrency or other market-based assets such as stocks or ETFs for that matter. Whether it's a down payment for a house or a necessary upcoming purchase, money that you need in the next few years should be kept in secure accounts so that it's there when you need it. And if you're looking for an absolutely sure return, your best option is to pay off debt. You're guaranteed to earn whatever interest rate you're paying on the debt. You can't lose there. And don't overlook the security of an exchange or broker you're using. You may own the assets legally, but someone still has to secure them. And their security needs to be tight. If they don't think their cryptocurrency is adequately secured, some traders choose to invest in a crypto wallet to hold their coins offline. so they're inaccessible to hackers or others. Cryptocurrency is a highly speculative market area, and many savvy investors have decided to put their money elsewhere. However, for beginners who want to get started trading crypto, the best advice is to start small and only use money that you can afford to lose. As a beginner, before you jump on the nearest crypto exchange, it's crucial to understand what you're investing in, the opportunities and the pitfalls. Very important. Investors who try to make money trading cryptocurrencies have many different strategies. Some of the main ones include: 1. Day trading. This is a fast-paced form of cryptocurrency trading where people buy and sell cryptocurrencies within a day to try to take advantage of short-term price movements. However, this may not be an appropriate way of trading crypto for beginners. This is because there's a significant risk of loss when trying to time the market. Number 2. Hedging. Hedging, where one of your investments cancels out some or all of the risk of losses with another, is a strategy used by some crypto traders who want to hold the coins but not be overexposed to volatile movements. You can hedge cryptocurrencies using financial instruments such as contracts for differences or futures. These allow you, in effect, to bet on the future price of the currencies. This is a tricky strategy that should only be used if you understand exactly what you're doing. 3. HODLing. Those who HODL a cryptocurrency keep hold of it through thick and thin. If it sounds like a typo, that's because it originally was. The term originates from a typing mistake on an early Bitcoin forum, but it's often retrospectively explained as standing for holding on for dear life. 4. Trend trading. Trend trading is where crypto investors decide to buy or sell particular currencies based on whether their price is moving up or down. There are many more complex theories on how to identify a trend or when it's going to change. But the basic theory is that these cryptocurrency traders buy in a market that is going to rise and sell when it's going to fall. The difficulty comes in identifying which is which. Whichever strategy you employ, it's important to be aware of the large number of cryptocurrency scams that exist on the internet and elsewhere. Bitcoin, Ether, and Dogecoin are some of the most famous cryptocurrencies, but there are now thousands to choose from. Choosing the right cryptocurrency for you will involve several factors. Fundamental analysis determines the intrinsic value of an asset, which is harder to do with crypto. You also need to factor in risk management, which we have mentioned. To finish off, remember, as with any investment, make sure you consider your investment goals and current financial situation before investing in cryptocurrency or individual companies that have a heavy stake in it. Cryptocurrencies can be extremely volatile. A single tweet can make its price plummet, and it's still a very speculative investment. This means you should invest very carefully and with caution. That's all about our video on tips on how to invest in cryptocurrency for beginners. If you found it helpful and would like to learn more, be sure to subscribe to our channel for more of our informative content. Please give us a like, share the video, and don't forget to turn on the notification bell for timely updates of our latest uploads. We value your feedback. Feel free to share your thoughts with us in the comments section below.